Ways to contribute. This section outlines the ideas behind Steem and its rewards for people who provide meaningful and measurable contributions to the Steem community. Capital contributions. There are two items a community can offer to attract capital: debt and ownership. Those who buy ownership profit when the community grows, but lose if the community shrinks. Those who buy debt are guaranteed a certain amount of interest, but do not get to participate in any profits realized by the growth of the community. Both types of capital contributions are valuable to the growth of the community and value of its currency. Additionally, there are two ways ownership can be held: liquid and vesting. Vesting ownership makes a long-term commitment and cannot be sold for a minimum period of time. The Steem network calls these different asset classes Steem, Steem Power or SP, and Steem Dollars, SMD. Steem. Steem is the fundamental unit of account on the Steem blockchain. All other tokens derive their value from the value of Steem. Generally speaking, Steem should be held for short periods of time when liquidity is needed. Someone looking to enter or exit the Steem platform will have to buy or sell Steem. Once Steem has been purchased, it should be converted into Steem Power or Steem Dollars to mitigate the impact of dilution over the long term. Steem is constantly increasing in supply by 100% per year due to non-Steem dollar incentives. Someone who holds Steem without converting it to Steem Power is diluted by approximately 0.19% per day. While the rate may appear high for transactions that take less than 10 days, it is still cheaper than credit card processing fees. Furthermore, the daily token creation is insignificant next to the daily volatility. Someone who buys Bitcoin or any other cryptocurrency and sells it 10 days later could easily lose 3% or more due to price fluctuations. Someone who buys Bitcoin and then sells it the same day will usually pay more than 0.4% in market fees alone. In other words, inflation rate is effectively insignificant during the period of time the typical individual will hold Steem. The majority of inflation is actually an accounting artifact rather than true reallocation of wealth. 90% of non-Steem dollar inflation is distributed back to existing holders of Steem, proportional to the Steem value of their Steem Power balance, making inflation more of a split. Only about 10% of non-Steem dollar inflation redistributes ownership in the network. Steem Power. Startup companies require long-term capital commitment. Those who invest their money in a startup expect to wait years before they can sell their shares and realize their profits. Without long-term commitment, a startup seeking to raise additional capital through the sale of additional shares would be competing with existing shareholders looking to exit. Savvy investors want their capital contributions to grow the company, but growth cannot happen if the new capital is given away to those looking to exit. There is significant value in having long-term commitment because it enables communities to make long-term plans. Long-term commitment of stakeholders also causes them to vote for long-term growth rather than short-term pumps. In the crypto space, speculators jump from cryptocurrency to cryptocurrency based mostly on which is expected to have short-term growth. Steem wants to build a community that is mostly owned and entirely controlled by those with a long-term perspective. Over time, this drives the ratio of the total Steem value of Steem Power balances to the total of Steem balances toward 9 to 1. It seems likely that the ratio will be somewhat greater than 9-to-1 due to a continued net powering down of the newly printed Steem. It also means that the long-term holders are almost completely protected from the dilution used to fund growth. Steem Power can be converted back to Steem over 2 years via 104 equal weekly payments. One Steem Power can be viewed as a share in a pool of Steem. The network automatically sends Steem to the pool every block. At any time, the users can convert their Steem into Steem Power at the same ratio as Steem in the vesting pool to total Steem Power. Converting Steem to Steem Power does not dilute existing holders of Steem Power. Likewise, every time Steem Power is converted back to Steem, it is done at the current ratio. Individuals are guaranteed to have more Steem in the future than they have when they first converted from Steem to Steem Power. Steem Power balances are non-transferable and non-divisible, except via the automatically recurring conversion requests. This means that Steem Power cannot be easily traded on cryptocurrency exchanges. Steem Power is a requirement for voting for or against content. This means that Steem Power is an access token that grants its holders exclusive powers within the Steem platform. Transferring from Steem to Steem Power is referred to as powering up, while transferring from Steem Power to Steem as powering down. For example, one can power down their Steem over a period of 2 years, yet one can power up their Steem instantly. Steem Dollars, SMD. Stability is an important feature of successful global economies. Without stability, individuals across the world could not have low cognitive costs while engaging in commerce and savings. Because stability is an important feature of successful economies, Steem Dollars were designed as an attempt to bring stability to the world of cryptocurrency and to the individuals who use the Steem network. Steem Dollars are created by a mechanism similar to convertible notes, which are often used to fund startups. In the startup world, convertible notes are short-term debt instruments that can be converted to ownership at a rate determined in the future, typically during a future funding round. A blockchain-based token can be viewed as ownership in the community, whereas a convertible note can be viewed as a debt denominated in any other commodity or currency. The terms of the convertible note allow the holder to convert to the backing token with a minimum notice at the fair market price of that token. Creating token convertible dollars enables blockchains to grow their network effect while maximizing the return for token holders. Steem Dollars are referred to with the symbol SMD, an acronym for Steem Dollars. Creating SMD requires a combination of a reliable price feed, rules to prevent abuse, and liquidity. Providing a reliable price feed involves 3 factors: minimizing the impact of an incorrect feed, maximizing the cost of producing an incorrect feed, and minimizing the importance of timing. Minimizing fraudulent feeds. Steem Power holders elect individuals to publish price feeds. These elected individuals are presumably trusted by those who have a vested interest in the quality of the feed. By paying those who are elected, Steem creates market competition to earn the right to produce feeds. The more the feed producers are paid, the more they have to lose by publishing false information. Given a set of trusted feeds and elected feed producers, the actual price used for conversions can be derived as the median of the feeds. In this way, if any minority of individual feed producers produce outliers, they have minimal impact on the actual median, while still having the ability to impact their reputation. Even if all feed producers are honest, it is possible for the majority of feed producers to be impacted by events beyond their control. The Steem network is designed to tolerate short-term corruption of the median price feed, while the community actively works to correct the issue. One example of an issue that may take some time to correct is short-term market manipulation. Market manipulation is difficult and expensive to maintain for long periods of time. Another example would be the failure of a centralized exchange or corruption of the data published by the exchange. Steem factors out short-term price fluctuations by using the median price over a period of 1 week. The median published feed is sampled every hour, on the hour. As long as the price feed corruption lasts for less than half of the moving median time window, it will have minimal impact on the conversion price. In the event the feed does get corrupted, network participants will have an opportunity to vote out corrupt feed producers before the corrupted feed can impact the actual conversion price. Perhaps more importantly, it gives feed producers an opportunity to detect and correct issues before their feeds start impacting the price. With a 1-week window, community members have 3.5 days to respond to any issues that come up. Mitigating timing attacks. Market participants have access to information faster than the blockchain's 1-week moving median conversion price can react. This information could be used to benefit of traders at the expense of the community. If there is a sudden increase in the value of Steem, traders could request conversion of their Steem dollars at the old lower price, and then sell the Steem they receive at the new higher price with minimal risk. Steem levels the playing field by requiring all conversion requests to be delayed for 1 week. This means that neither the traders nor the blockchain has any information advantage regarding the price at the time the conversion is executed. Minimizing abuse of conversions. If people could freely convert in both directions, then traders could take advantage of the blockchain's conversion rates by trading large volumes without changing the price. Traders who see a massive run-up in price would convert the Steem dollars at the high price when it is most risky, and then convert back after the correction. The Steem protocol protects the community from this kind of abuse by only allowing people to convert from Steem dollars to Steem and not the other way around. The blockchain decides how and when to create Steem dollars and who should get it. This keeps the rate of Steem dollar creation stable and removes most avenues of abuse. Sustainable debt to ownership ratios. If a token is viewed as ownership in the whole supply of tokens, then a token convertible dollar can be viewed as debt. If the debt to ownership ratio gets too high, the entire currency can become unstable. Debt conversions can dramatically increase the token supply, which in turn is sold on the market, suppressing the price. Subsequent conversions require the issuance of even more tokens. Left unchecked, the system can collapse, leaving worthless ownership backing a mountain of debt. The higher the debt-to-ownership ratio becomes, the less willing new investors are to bring capital to the table. For every Steem dollar Steem creates, $19 of Steem is also created and converted to Steem Power. This means that the highest possible debt-to-ownership ratio in the stable market is 1 to 19, or about 5%. If Steem falls in value by 50%, then the ratio could increase to 10%. An 88% fall in value of Steem could cause the debt-to-ownership ratio to reach 40%. Assuming the value of Steem eventually stabilizes, the debt-to-ownership ratio will naturally move back toward 5%. The idea behind having a conservative 5% debt-to-ownership ratio is that even if all debt were converted and sold, there should be ample buyers, and the effective dilution of the token holders remains relatively small. A rapid change in the value of Steem can dramatically change the debt-to-ownership ratio. The percentage floors used to compute Steem creation are based on the supply, including the Steem value of all outstanding Steem dollars and Steem Power, as determined by the current rate. Interest. Steem dollars pay holders interest. The interest rate is set by the same people who publish the price feed so that it can adapt to changing market conditions. All debt carries risk to the lender. Someone who holds Steem dollars without redeeming it is effectively lending the community the value of $1. They are trusting that at some point in the future someone will be willing to buy the Steem dollars from them for $1, or that there will be speculators and investors willing to buy the Steem they convert it into. Steem and Steem Power holders gain leverage when members of the community are willing to hold Steem dollars. Steem holders do suffer from an increased dilution if the price falls. Cryptocurrency projects have shown that the gains from increasing the user base willing to trust the network with capital ultimately add more value to the network than any dilution that may occur during a downturn. Setting price feeds. Astute readers will recognize that an interest-bearing asset of limited supply may trade higher or lower than the underlying asset, depending upon other opportunities to earn interest on the same asset. With a high interest rate paid on an asset pegged to the US dollar, many people will bid up the limited supply of Steem dollars until they are no longer valued at $1. In economics, there is a principle known as the impossible trinity, which states that it is impossible to have all three of the following at the same time. 1. A stable exchange rate. 2. Free capital movement. 3. An independent monetary policy. If Steem feed producers aim to have an independent monetary policy allowing it to create and destroy Steem dollars while simultaneously having full control over the interest rate, then they will encounter problems. The impossible trinity says that Steem dollars either need to restrict capital movement, have an unstable exchange rate with the dollar, or have limited control over the interest rate. The primary concern of Steem feed producers is to maintain a stable 1-to-1 conversion between Steem dollars and the US dollar or USD. Anytime a Steem dollar is consistently trading above 1 USD, interest payments must be stopped. In a market where zero interest on debt still demands a premium, it is safe to say that the market is willing to extend more credit than the debt the community is willing to take on. If this happens, Steem dollars will be valued at more than $1, and there is little the community can do without charging negative interest rates. If the debt-to-ownership ratio is under 10% and a Steem dollar is trading for less than $1, then the interest rate should be increased. This will encourage more people to hold their Steem dollar and support the price. If a Steem dollar trades for less than 1 USD and the debt-to-ownership ratio is over 10%, then the fees should be adjusted upward to give more steam per Steem dollar. This will increase demand for Steem dollars while also reducing the debt-to-ownership ratio and returning Steem dollars to parity with the USD. Assuming the value of Steem is growing faster than Steem is creating new Steem dollars, the debt-to-ownership ratio should remain under the target ratio, and the interest offered benefits everyone. If the value of the network is flat or falling, then any interest offered will only make the debt-to-ownership ratio worse. In effect, feed producers are entrusted with the responsibility of setting monetary policy for the purpose of maintaining a stable peg to the USD. Abuse of this power can harm the value of Steem, so Steem Power holders are wise to vote for witnesses that can be counted on to adjust the price feed and interest rates according to the rules outlined above. If the debt-to-ownership ratio gets dangerously high and the market participants choose to avoid conversion requests, then the feed should be adjusted to increase the rate at which Steem paid for converting Steem dollars. Changes to the interest rate policy and/or any premium discounts on the Steem to Steem dollar conversion rate should be a slow and measured response to long-term average deviations, rather than attempting to respond to short-term market conditions. The blockchain is paying liquidity providers for their service and absorbing short-term demands. It is our belief that these rules will give market participants confidence that they are unlikely to lose money by holding Steem dollars purchased at a price of $1. We fully expect there to be a narrow trading range between 99 cents and $1.01 for Steem dollars under most market conditions.